All right, let's get going. Good morning. How are you? I got my cup of chino. That's some good ghee. Must be grass-fed. Anywho, good morning. What are we going to do today? What are we going to do today? How about some gold, oil, and Bitcoin? How about some dollar or some yen or some Swiss franc? Yeah. The question is up or down, long or short, buy or sell. And I posted a poll. Would you please be so kind to let me know what your intent is today? And we can learn from the aggregate. So welcome to Forex.Today, the YouTube community of more than 20,000 foreign exchange traders. We gather here today to try to lower our volatility and produce consistent returns. Because trading is risky and not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. My name is Wayne. I like money. I like business. I like entrepreneurship. I like capitalism. I'm a capitalist big dog. I think money is the root of all good. So let's make some money, huh? The thing is, Forex is not a get-rich-quick opportunity. That's a fool's errand. There is no such thing as get-rich-quick. It's like the dumbest thing ever. Instead, you should look at Forex like a business, and all businesses must produce value. Yeah. So our value creation is through strategic analysis of macroeconomics and monetary policy. Then we drop into our charts using technical analysis to find the right price and time to buy or sell. Move the camera up a little bit. Check this out. I can actually move my whole monitor with 2 fingers. That's I didn't touch the camera. That's the monitor. Cool, right? So anyways, you should look at Forex as a business. I'm going to take the silver watch off and put a white watch on. Why not? I have a white shirt on today. Keep all your watches on your desk. Anyways, you should look at Forex as a business. Wait, is that upside down? Can't even see my watches anymore. That's upside down, right? Yeah. Treat Forex as a business. You create value. And your value is your thoughtful analysis of the market. You need to think into the future a little bit. You don't necessarily have to think next year. Okay, but you should think about what's going on now. What are the market conditions? This watch is weird. That's why I don't wear it. Better? Yeah, better. And then once you look at market conditions, you try to trade your bias. So the biggest thing that I'm concerned about today, me personally, is what the S&P 500 is going to do next. It blew through some of my support levels, so I might want to sell the rally. You know? Sell the rally. Even if it's an up day, I might be selling. Yeah. Cool. So that's what we need to do. And maybe you can help me make the right decision. If you look at the description below today's video, there are many links. They're all resources made for you over the 20 years that I've been, sharing my strategy as a foreign exchange trader with the world. Remember, I do this because in the very beginning, after I quit my job, left a very nice job to become a foreign exchange trader, I realized very quickly the isolation was killing me. I was not producing the results I had anticipated. I thought about it and I asked myself, how did I find success before? Because before Forex, I had found a bit of success. I was somebody in the Silicon Valley. I was the coach and mentor to dozens of high-tech startup CEOs. I knew dozens of the of venture capitalists from the biggest firms and lawyers and accountants, and wow, was in magazines and newspapers all before Forex. So there was some level of success in my life. When I was 21, I ran a company of 3,000 people. That's not bad for a young man. So I asked myself, how did I find or achieve some level of success in the past, and why is it not happening in Forex? And I realized I was doing Forex all by myself, and I'd never done anything successful in my life doing something on my own. You need good people, like-minded people around you. Or now I can just hire some AI. No! So anyways, so thank you for being part of this community. I have to get up in the morning, work hard, be sharp, and look pretty for you. You got to have a game every day. So thank you for that. It's good. We have a very symbiotic relationship, and I love it. So over those 20 years, some people asked me to write a book many years ago, so I did. The link is in the description below. People asked me for training videos because they'd see me trade every day, but then they're like, but I need to learn how to do that. Sweet. So there's 88 hours of videos for $88. That's in the description below. Some people are like, Wayne, I want your chart templates. Sweet. All those chart templates are part of FX Bootcamp. It comes with the $88. Hundreds and hundreds of files. No problem. It's all included. Sweet. Wayne, I need help with macroeconomics. Well, you can take the training courses at FX Bootcamp, or you can use QuantBox, which now automates the macroeconomic research process. Oh, well, shoot. Thank you, Wayne. Hey, you're welcome. Wayne, I need a broker. Which one do you recommend? I recommend tradersway.com. I have for 7 or 8 years. All this stuff has been done for you. The thing is, are you going to leverage those resources? I don't know. Right, Luis? So anyways, so tradersway.com, quantbox.co, fxbootcamp.com, and then the link to the Amazon page for the book. Okay? Sweet. Get on with it. So yesterday was a big day, and today has been a big day in earnings season. Meta made a lot of money today, huh? So maybe some risk on. So maybe risk on today, but the decision is, do you sell the rally? Will I be joining the metaverse? No. I don't like it. I think the idea is stupid. But I made some mistakes in the past as a venture capitalist. Definitely in my role back in those days, I made a lot of good decisions, and I've been humbled a few times. Which really, shows you it's hard to predict way, 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 way out in the future. But I always think of human nature. Okay, I think nerds would want to find a way to avoid reality. I'm one of those guys where I'm a nerd, but I'm not a nerd. I'm a jock, but I'm not a jock. I'm a social butterfly, but I'm not a social butterfly. So I was one of those kids that could float through all kinds of groups, and I had all different types of friends. I'm actually throwing a party at my house in a couple of weeks, and I got self-made millionaires coming in from all around the world, and they're all different types of people from different walks of life, and it's really interesting. So I was one of those guys. So I can see from a nerd's point of view, oh, we can get together and we could do the board meeting wearing goggles. And then I can see another personality saying, dude, wait, what? Instead of doing the board meeting in a fancy building, in a fancy office in New York City, and then go out and have a fancy dinner at a fancy restaurant, drinking fancy wine and eating fancy food, and then going back and staying at a fancy hotel, and then flying around in my private jet, you just want to knock this out using goggles? I'm like, dude, why would I want to do that? If I'm going to sit on your board of directors, I want to fly in the private jet. I want to stay in the fancy hotel. I want to go out and have a $5,000 dinner, eat my Kobe beef, and drink a Chateau Neuf de Pape. I want to wear a fancy suit and show off my fancy watch and my cufflinks, and I want to go into the fancy office. Like, dude, I like hanging with real people, right? But I can see the opposite. So anyway, so when I look at the metaverse, I'm like, that makes total sense to me that that's how Mark Zuckerberg would look at it. But not everybody's Mark Zuckerberg. I think if he was a little more astute 2 years ago when he made the shift to metaverse instead of Facebook, I would have switched to AI. You know, AI would have been probably better received than metaverse. And so now artificial intelligence is the big thing. So I think he was on the right track that posting pictures of your vacation on Facebook is probably maxed out. And there's no growth there. But metaverse is like, but, you know, maybe it'll happen. I like the real world. Okay? Hey, Siri, what does a rose smell like? I'd rather go to a rose garden. Have you ever done that? Go to a rose garden where they have 300 different types of roses and you just walk through the rose garden smelling each individual rose and talking to your friend, actually talking to them. Oh, what do you think of this one? Ooh, it almost smells like citrus, like a mandarin or an orange, or, you know, like, whoa, I like the real world. So anyways, good luck, Meta. But look, if they have 1 billion people they can sell ads to, great. Longwood Gardens, incredible. Yeah. Yeah. My favorite roses are in a secret spot in Paris, and I'm not going to tell you about it because it's such a tiny little park, dare I call it. There's like some roses and a park bench, and it's all fenced off. And anyways, that's for me. That's mine. Everybody should have one, right? Truckee Mogul says, I feel that it's banking on the younger generation to make metaverse work. Yeah, sure. You know, another interesting experience I've had throughout my life many times running FX Bootcamp is I put social stuff on the website. And at first, people use it a lot. They're like, oh my God, this is so good. I can chat with, Denise and Maida, and we can post things, and I can give you feedback. And then 6 months later, crickets. Nobody's doing jack. Maybe, and I've just once again launched social tools, and maybe it'll work out better this time. Cool. Great. Maybe, right? But I could see that Mark Zuckerberg spends $100 billion building a metaverse, and ultimately nobody gives a damn. And I wouldn't want to invest into that. Now, if he builds a metaverse and billions of people are using it every day and it becomes real, there'll be other opportunities for me to invest and capture that. So, like, you didn't have to invest directly into the internet. Okay? You could have invested, once the internet became a thing, maybe you invested into Cisco systems. Apple Computer was my very, 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 very first stock investment. I was a very young man, and I invested some money into Apple Computers. It was the very first company I ever invested into. The second one was Cisco Systems. Now, bear in mind, like, how did I pick these stocks? I worked at Apple in 1996. Yeah, well, too bad for you. Yeah, I worked for Apple. It might have been late 1990. No. I worked for a different startup. Yeah, 1996. I worked at Apple Computers, right across the street from Infinite Loop, in the very, very, very first building Apple ever utilized. The same building that Steve Jobs and Steve Wozniak first rented for their startup after they raised some venture capital. No joke. And in one of my first meetings, by the way, the meeting room in which I was hired was decorated in a Japanese samurai theme. Who do you think did that? Yeah, clearly Steve Jobs. And in the corner of the room, there was a pile of garbage. That's what it looked like. It was just some 2x4 or plywood and some bunch of crap sitting in the corner. And they said, well, do you have any other questions for us in the interview where they hired me, right? They're like, do you have any questions for us? And I'm like, well, I got one burning question. What's that pile of garbage in the corner? And they're like, oh, that's Lisa. I'm like, Lisa? The prototype of the first Apple computer? And they're like, yeah. And I walked over there and it was all pencil marks and stuff where Steve and Steve, the Woz, right? Jobs and Woz, hand sketched where they would put all the components. Now it's in a museum. So anyways, right? And then Cisco Systems was the other one. It was the second one I worked for. And so anyways, there's other ways to invest. It's not like if you miss metaverse, you'll never have an opportunity to invest into the metaverse ever again. And that's not true at all. If it works, there'll be a million ways to invest. All right, so we have 46 votes now for your sentiment. Let's see how you guys feel. Okay, and there you go. So be very cautious today. I know that the data sample isn't very deep, only 46 people voted, but it's enough. And you can see we have, right, 1/3 up, 1/3 down, 1/3 sideways. So be careful out there. Make sure you know what you want to do. Okay? So the way that trading on a floor worked is in the morning you'd have your order card. Right? Denise was a floor trader. Maybe this is how it worked for her, although I think right? Anyways, you'd get your order card from upstairs, from downtown. You'd get your order card for the day, and it would say, these clients want to be long, these want to be short, these want to take profit, okay, that kind of stuff. So these want to be long, so that's an in, that's it, right? These want to be short, that's an in. And then these are the customers that want to exit. Okay, cool, right on. So you do some basic calculations. You look at what happened yesterday. You look at the open, the close, the high, the low. Okay? Is that right? Yeah, that's why I was going to say maybe this was you, but then I'm like, "Oh, I don't think so. So anyways, so I just kind of took my foot out of my mouth and just kept going. So anyway, so you would look at the yesterday's open, yesterday's close, yesterday's high, yesterday's low. You do some calculations, okay? There's a flat line. Where's the average? Now, most traders back then, they wanted to incorporate sentiment. That's why you did open and close. So you're like, okay, we opened high, but we closed low. So I'm going to tweak my median price lower. So I'm going to skew downward because it closed lower than it opened. It's a little more bearish. Yesterday was more bearish than bullish. So we call that a weighted mean, which is just a mathematical way to include sentiment. So you look at high, low, open, close, and you create a central pivot point. And then from that, you're like, okay, so all my buyers I want to buy low. So I'm going to calculate essentially, this is essentially what it is, a standard deviation lower. Okay? So all my buys are going to happen between the M2 and the central pivot point. If it's an uptrend. If it's a downtrend, okay, you might have a different plan. Then you look at your bearish trades and you calculate all of those and you're like, okay, between somewhere around the M3 and the central pivot point. So really the M3 is where you're going to start selling. And down around the M2, you might consider buying. Okay? And then your exit, well, are they bullish exit or bearish exits? And so now you're looking at M4 to R2, M1 to S2, and you're doing all these calculations, excuse me, and to keep you sane while you're on the floor in the pit, you're like, if we get down to these prices, I'm going to start buying. If we get up to these prices, I'm going to start selling. See? No, we'll get there in a bit. We'll get there. I want to look at the calendar. Okay? But you see how before the market opens, they're making these calculations. And it's very similar. Well, it's exactly the same, actually. This is how I teach you to trade. I teach you to trade like any other professional would. So I don't know if YouTubers teach you how to trade this way, but professionals trade this way. And you could say, well, around this price, I'm going to start selling. Like in this case, if you're a floor trader for a broker firm, right? You're like, I'm going to start selling some there, and I'm going to start selling some here. That's also a bullish exit. So you exit all the bullish trades that want to exit, and maybe you end up selling bears that want to sell. So you're like, plan A, plan B. Okay? And then down here, you're like, this is my plan A long, and then this is my plan B long. And now you organize all your trades for the day. Okay? Now, this is really different from a lot of traders on the retail side because a retail trader logs in and sees green all day, right? And they're like, well, it was green all day, so I guess tomorrow is going to be green too. No. Bears sell green candles. And this is where amateurs get left behind. All of a sudden, there's a giant down day. So then an amateur comes in and sees, oh, I guess it's a lower low. We will be selling, right? No. Then it does this on you. Okay? And this is describing now a month. That's it. That's all there was for the month. Okay? So these are big decisions now. I'm putting my big girl panties on. And I'm trying to decide. Actually, I got to put that back. I'm trying to decide my behavior today. Will I do this? And the answer is probably. Yep, probably. Usman says, when is the recession going to begin? Great question. It's the right question. And I believe in the past, you've asked really good questions, and I always give you the same answer. I've already discussed it. I discussed it in January, and I discussed it at the end of March. Okay? Now, I charged $11 because it took me an hour and a half to answer the question. So for $11, I'll answer the question if you schedule an hour and a half. Oh, wait, I recorded it. Oh. I went to Italy for a while, so I never took it down. Okay, so anywho. Yeah, the GDP is a big one. Louis says, yeah, 4,100. Yeah, that's basically it, right? I have 4,109. I don't know where you get 4,110. That sounds ridiculous. Luis, I'll be in 1 point before you. Okay, it's actually 4106 using shorter term, meaning the current mark, but I'm trying to use the future mark. Anyways, let's take a look. Let's do some basic calculations here and take a look at the world as we know it. It's the end of the world as you know it. Man, I want to get to New York City. I want to go. I want to travel. I want to go. I want to travel, baby. I got to raise, I'm starting a hedge fund. I think you guys know that. I'm starting a new hedge fund. Yet another fund. Well, part of being a hedge fund manager is you're constantly launching funds. It's a closed-end fund on this one. Right? Probably only 10 to 15 M, maybe, depending. Which means roadshow! Roadshow! Oh, I love roadshows. I love roadshows. Yeah. It means you get to travel and have steak dinners, smoke cigars. You're like, Mom, will you invest? So anyways, looking forward to that. Got to put gas in the jet, in the private jet. Louis says 1.1. Yeah. Great. So you mean last, right? You mean things were bad in the past? Uh-huh. So anyways, I can't really do anything until the stock market opens to enter my hedges, so I have to wait here. I like, Denise says, my job was to provide two-sided market to the public. I'm like, no, it wasn't. I'm thinking it's more like the bigger traders, Denise, were slothy, lazy, or stupid, or greedy, right? And you live off their crumbs. Like the way I described it in the book, there's 800-pound gorillas in the market. And you would be a fool to challenge an 800-pound gorilla. Now these gorillas, they climb the trees and they grab all the bananas, and right? But the thing is, they're just so rough and so They're so big that they can't, there's no finesse to these giant creatures. There's nothing subtle about an 800-pound gorilla. So they climb the trees and they take all the bananas. But, you know, they're dropping most of them, right? Like they got this many, but there's bananas falling, and then they come out of the tree and they sit there and they gorge on their bananas, and then they fall asleep. And that cheeky little monkey just goes in there. They don't climb the tree to pick the bananas. They don't fight the 800-pound gorilla to get the bananas. Shoot, there's enough bananas just laying around because of, right? How many bananas the 800-pound gorilla dropped. And so now the gorilla's leaning against a tree, snoring after gorging on all these bananas. So a cheeky little monkey just runs in there, grabs all the bananas off the ground and leaves. And that's how, that's, to me, any independent trader is just living off the bananas that 800-pound gorillas dropped because of their, right? They're just big, messy, slothy animals. Plenty to go around. Okay. Yeah, see? Gotta wait for the open. Anywho, what's going on here? What's going on? Nothing's right on tone. So on the left is what has been happening technically. See all this? I'm just organizing everything technically. Everything here in red is bearish, technically. Everything here is bullish, technically, on daily charts. Okay, all these little cards, that's real time, what's actually happening now. Okay, everything in pink and red is down. Everything in blue is up. Everything gray is essentially neutral. Okay. So anyways, just looking around, S&P 500 already down 0.38. Okay. That would mean dollar up. Okay. That would mean dollar up. Euro's been going up when the stock market's rallying, so you might argue euro would come down if the stock market's falling. Well, euro dollar's down, euro CAD is down, euro pound is down, euro yen is down, euro Aussie's down. And all those, right, even euro kiwi's down. But remember, all of those were up on risk on days. Oh my God. The Euro Kiwi, which I've been pointing out a lot in the day trading group, and it's on QuantBox. It's like, dude, Euro Kiwi looks good. And today the stock market's is down, and even unbelievably, even Euro Kiwi. Okay. Okay, look at seasonality. You see that? Get long, baby, get long. And look at that. Look at the result. The gray is actually what happened. Okay. Look at this. 75%. Okay. 75% of professional traders are long this sucker. And 84% are short. Oh my God, oh my God. Anyways, retail having a bad time. Look at how beautiful this is. Beautiful, beautiful. So anyways, statistical analysis of this pair says if nothing changes in the trend, remember it's a model. Of course the trend's going to change. But they're saying if things stayed exactly the same on trend as, right? All it's doing is rise over run and then calculating the variance. Does anyone remember how to convert variance into standard deviation? Simple math. I used to have to do this. I did this in an exam where they're like, here's a data set, a scatter plot. Figure out the standard deviation. You guys remember that? Like, for example, I'll go over here again. Here's, if you don't know what a scatter plot is. They give you something like this, and they're like, calculate the standard deviation. Okay? This is definitely an off day. I can look at the scatter plot right away and say, oh my God, it's an off day. Thank you, Richard. That's right. Take the square root of the variance. Richard. Look at Richard, man. On fire. Okay, like in the math is easy. And if you want to know which math, it's statistics. Okay? And you do a lot of this in calculus too, but this is statistical analysis. So you figure out the average. Okay? Okay? Oops. You figure out the average, and then I'll do this, right? And then you figure out the rise over the rise over the run. Okay? And then you figure out the variance, how far on the bullish side does price tend to go. So now you're trying to kind of get almost like the average of the high. And then you look at the average of the low. So now you have outliers here and here. Okay? So then you calculate now from the distance from that to that, and the distance from that to that, which is the variance. And then you take the square root of the variance, and you get the standard deviation. Square root of the variance is equal to the standard deviation. First of all, come on, give me some love for that. Come on, click the like button. Kick down, come clean. Don't be a holdout machine. Now I'll tell you why it's important. Okay, it's important because you look at all of this, and this is essentially a scatter plot of prices. Remember, price and time, price and time, price and time. Then, as every new one comes out, so let's say the close every day, daily close, let's say, you create the standard the mean. Then you calculate the slope of the mean, so the rise over the run. Okay? Then you look at the above and below to calculate the variance. Then you take the square root of the variance to get the standard deviation. And now you project the rise over the run all the way to the future now. You could just take the same slope and continue it forever. In this case, QuantBox is only going 7 days out. Then you what? You look at the variation above and below, and then take the square root of that to get the standard deviation. And then you say, well, if the rise over the run continues at the same slope, and you have a standard deviation, right? Then you get the projection worst case and the projection best case to try to analyze what is likely to happen in the future. And that's why you do it. It's a linear projection. Isn't that pretty? And trust me, I'm not a mathy guy, but if somebody can get passionate about calculating, right, standard deviation, then there's hope for everybody. Okay, Darko, I don't trade funding pairs against each other, so not interested. Okay. Really? So only half of you guys click the thumbs up button? You're not impressed. You've seen it too many times, huh? Well, I hope you understand why we do it. And so if you don't do these calculations, well, QuantBox does them for you. Okay? But look at this. Things are changing. Between May and July, very, 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 very often, this stops working out. Huh? Huh? Oh, wait, what? What? Wait, what? This is the end. My only friend, the end. I'll never look into your eyes again. Anywho. Can you picture what will be? And free. Desperately in need. In some stranger's hand. All right, cool. Cool, man. Cool beans. Yeah, I got to figure out what happened here. I want to know how many. I mean, look, it's redundant. I want to know how much time until the event. So I'm going to have to figure out that. Okay. Boo, boo, boo. Desperately in need. In some. I'm going to do that one. Cool. So anyways, we'll get there. We'll get there. We'll get there. I guess that's actually should just be time. Maybe that's what's going on. I wonder if I can fix that. I wonder if I can fix that myself. Hang on. Don't need a developer to fix that, do I? Date. Date. So the second one. What is this? Date. Can I switch this to time? Time. No, I'll have to ask the developers. Anyways, we'll leave QB alone. What a great tool, though, huh? Bumpy, if you need somebody to think for me, just pay money. I'll think for you. Give me $1 million. I'll think for you. I'll make all the decisions, and I'll give you most of the money. It's a pretty sweet deal. Cool. So anyways, big day today. Big day today. Are you selling the rally? Okay. And that's my intent, I think, today. The market doesn't open for another 45 minutes. Yeah. Bumpy, right? Come on now. Yeah, but it's true, right? Like there are mechanisms for that. There are mechanisms, and that's all I'm saying. You know, the scarcity is just time or money, right? I talk about this in the description for. Actually, is that in today's description? Yeah, the webinar's in here. Check this out. in the description below today's video, there's a link. It says free webinar, 3 trading secrets that may triple your profits without changing your indicators and while spending less time at your charts, and how to do it all 3 for free. Which is funny. There's only 2 things. How to do them all. And how to do it all. It all. Funny. It all. For free. Anyway, so there's a link to that. And one of the things we talk about right off the bat is scarcity of time and money. So so going back to that, in all seriousness, let me go back to being serious again. Let me get back to the chat. Okay, so bumpy, right? All right. The process for making the decision. Oh yeah, Jeffrey, that was done a month and a half ago. Yeah, a month and a half ago. So anyways, the process to making a decision. So like, in other words, is the dollar going to go up or is the dollar going to go down, right? Right. You need to make that, or the decision needs to be made. Okay, right? Great. And to me, a lot of that is fundamental analysis, right? Right? We'll just say that. And so what I cover in here is it has to be done. You know it has to be done. Like, if you don't think it has to be done, you're like, Wayne, fundamentals are BS. I don't need to know anything about macroeconomics or microeconomics. I'm like, cool, then don't buy QuantBox. I'm not going to be able to convince you. So good luck, right? But for those that are like, dude, I know there's more going on in the charts, then look, one of the things I cover, or the thing I cover in this presentation, which is about an hour and a half, I think, if I remember correctly, I will show you how to do it, and I'll show you where to get the information. So I'll show you, like, literally, this is what you need to do to answer that question, Bumpy. All of that's in there. How to get the information and how to use the information to make that decision. Okay? So the idea is you can do all of it for free, and I'll show you how to do it for free. Literally. You take it, you will learn, you can go do it. And then at the end of it is, well, QuantBox can do it for you. So you can invest your time, which is great, right? And I'll show you how. Again, go to these websites, use this information. This is how you use it. Great. So you can just do it on your own. That's great. You can invest your time, or you can invest your money. And you're like, I just want QuantBox to do it for me. Okay? Because it comes down to what's more valuable for you. I don't know your situation, right? You might say, well, I don't have any money, but I have a lot of time. Or you're like, I have a lot of money, but I don't have time. Or I have some money and it's worth more than my time. I want to free up my time so I can spend my time trading. Right? But it's the choice, right? This is ultimately the choice that we all make. That's what economics is, by the way. Time or money. Time or money. Time or money. Time or money. Okay? You can paint your own house and save money. Or you can hire a painter and save time. It's awesome. This is why economics is a social study. It's social sciences. Isn't it interesting? What does the person choose? It depends on the person's variables. How much money do they have? How much time do they have? You see? So anyways, like, in all honesty, watch the video. And then you can make your decision. Are you going to use time or money? Really cool. Okay? And you'll get a glimpse of what Quantbox is actually doing to make these decisions. Cool. Cool, man. And then you can go do it. Okay. That link is in the description of under today's video. Richard says, hey, Wayne, a 1.1 GDP tells what story? Yeah, in the past, the economy grew by a little bit. But we already knew all that, so who cares? So I keep saying, who cares what the economy was doing? Oh, it was slowing down. Really? That's a shocker. Okay, I'm not interested. I'm interested in what the Fed is going to do in the June Fed meeting. You're like, wait, no, Wayne, you missaid that. The meeting is on May 3rd. No, I'm not interested in the May 3rd meeting. I'm already done that. I'm done. I'm interested in, what is it, June 14th? June 20th? I'm interested in the June meeting. This is where I'm at. So again, if I'm trying to figure that out and you say, Wayne, GDP in the first quarter was 1.1, I'm like, dude, I'm almost done the second quarter. I'm really trading the second half, really. Because if the meeting's June 20th, and the end of the quarter is June 30th, I'm really already in the second half, man. Yeah, June 14th. Thank you, Jim. And so I'm already fading the summer. I'm probably setting up scenarios for the fourth quarter. So I'm farting around the third week of August to third week of September is the window that I'm putting together now. And of course, I'll have a lot more information by the time we get there. But I've already outlined my concerns for that in my quarterly outlook. And I already gave my concerns about that period way back in January when I did the annual outlook. So I'm all on plan. I'm all on trend. Cool. So again, with that in mind, Wayne, we had a slowing GDP in the first quarter of the year. Right? You're like, yeah. Really? No, it's not surprising. Like, who cares? It's done. I'm not interested in that. Okay? Now, as an economist, I care. As a trader, I don't care. Okay? Bumpy, the market is 6 to 18 months in advance. Okay? Okay? So, for a proper inverted yield curve, where I guess you can see this if I draw this. We'll do it over here. 2-year, 5-year, 10, 20, 30. Okay? How do you do this? 2, 4, 6. Okay? All right. Got my chart. Now you have to do this. This is time. This is yield. All right. So when you get a yield curve that looks like that, 6 to 12 months later, you'll get a recession. So when did that happen? Well, we're getting close to the 12 to 18 month period, right? So if I just did that yield curve analysis, okay, then I'd say, well, probably in the next 6 months, we'll look at a recession. Oh, sweet. Using what rule, I ask. And you're like, oh, well, that would be 12 to 18 months from the inversion of the yield curve when the 2 went higher than the 10. Okay? And I talked about this in 2008. 2008. I talked about the TED spread. The VIX. And the TED, the VIX. There was one other. I don't remember the other. Anyways, I pointed to 3 basic things that showed recession was coming and that you had 6, really back then it was 6 to 12 months to prepare for the inevitable recession. And I explained why it leads to recession. Not that it's just a rule, but how it impacts. What was the third one? Wouldn't have been the dollar. I don't remember. Anyways, it was a great presentation. It stunned the room into complete silence. It was the only time I ever walked off stage in complete silence. That sounds bad, right? And I'm not even joking. After the presentation, a New York police officer came up to me, gave me his business card with his name on it, and he said, if you ever have a problem, if you ever get pulled over in New York, just show him this card. Okay? And you're like, that's pretty powerful, right? Another guy, I gave the presentation in the Marriott Marquis, so Times Square. The guy ran down the street. I suppose it's uptown, right? So up the street towards Carnegie Deli, which is now closed. It's so sad. And bought me a cheesecake and ran back. I'm not even joking. So after the presentation, I was in the hall for about an hour just answering people's questions. And he came up to me and he's all sweaty. His hair's all messed up. He's sweating. And he hands me a pink square box. Here, I got you a real New York City cheesecake. And I'm like, oh my God, you're crazy. Anyway, so I do remember giving the presentation. The VIX, the yield curve. Maybe it was VIX, yield curve, and then TED spread. But see, the TED spread and the yield curve are synonymous, so I'm not sure what I did. Okay. You know what? What do I make of today's GDP report? I just answered that 3 minutes ago. Anyways. So good. This is interesting. I want it to go up so I can sell it. I still have almost just a little under 30 minutes to get on with that. Okay. Now, this we covered last night in the day trading group. I set this entire chart up. For example, I added this bright orange line. I don't think it's red. Maybe it's red. I added that red line. I added this in here. I talked about this zone here. Okay. Anywho. And we said, can't sell it, but if you're a bull, that would be your entry. And if you're buying it, what you're saying is, tonight. Uh-oh. Yeah. You're saying that the Bank of Japan is going to have the first meeting under the new regime, and they're going to say, okay, no change. So delta no to YCC, and there's going to be a rally. Okay, that's what's going on, Bumpy. Because tonight, uh-oh, the BOJ has a meeting. Okay, I can't remember what time they do it. Is it 10 a.m. their time, which is 10 p.m. our time in New York City on Wall Street, 10 p.m. tonight? It might be noon, which would be midnight tonight. But shortly, in less than 24 hours, the BOJ will probably announce no change to the YCC Nikkei rallies, but I covered this yesterday. You're welcome. Now, Peter makes a very astute comment. Thank you, Peter. Amazon earnings today more important than GDP. Yes. Yeah. I concur. Okay. Cool. Okay. So what do you think, guys? Okay. Yeah. Now, if you disagree with that case, that's perfectly fine. And so now you would be setting up the short. And you might, I don't know the way you do your analysis. Okay. But I know how pivot points work. And so you could have pivot points say, oh, you're a bear. So you are looking at a closing sentiment that's lower, right? So you're going to skew, by the way. Here's a normal distribution. And your skew would be bearish. So you're going to look at it and say, there's a bearish skew. Okay? So you would take that sideways. So if you're bearish and you're doing statistical analysis, and you're like, but wait, I'm on this, I think the Nikkei is going down in the next 24 hours and drop for the next week or two or three. Okay, great. So you're a bear. Statistically, you're measuring all of this, great. And then we consolidate, great. Then you got your lower low, lower high, and lower low. And that's your skew, right? You're saying the distribution has been this way, neutral, to now the distribution is this way, which is bearish. Yeah, cool. Yeah, that's all. That's it. So, right? So the only difference is the peak to your distribution. Price and time. The distribution of price and time as a bear. Sweet. So now you're setting that up. Bulls have nothing to do. Bulls worked last night. Because the one thing we know as if you're a bear, you can't do anything here. So only bulls have an opportunity. See what I drew here? If there are bulls, we know there's a bearish exit and a bullish opportunity. Do we know it's going to be up here in a week or two? No, we do not know that. We don't. Do we know if it's going to be down here in a week or two? Once again, no, we don't know that. So what do you think? Okay, and of course, if this was a college paper, support your argument with facts and cite your sources. Don't tell me what you think, right? Tell me what you know. What do you know? You know facts. Okay, great. So, what's happening next? Well, bears now have a job. They might sell here and they might sell here. Okay, what would make them sell? It depends on what the bulls do. Oh, snap. Okay. Now, Bumpy says, for sure, not trying to disagree with the direction of the market, right? Doesn't matter what anyone thinks. The truth is in the charts. That's only partially true. Okay? Now, I know lots of people say that. It's because they don't understand what the truth is. So, one factual thing you can rely on is the price and time data. It's true. This is what's happening. So you can say that's all you need to know. Okay. Really? I always find that so short-sighted. That's all you need to know. Everything's in price and time. Usually what that tells me is, and I'm not talking about you, but I'm talking about somebody that says, all the other gobbledygook is irrelevant. All I need is this. What you're telling me is you don't understand all the other stuff. So what you're saying is, when somebody tells me you don't need to know all that stuff, what you're telling me is you don't know all that other stuff. The limitation of saying everything is price only, everything's in the price. I mean, you're basically saying efficient market theory, right? Efficient market hypotheses. Now, again, usually somebody that says that doesn't understand that concept. They don't have a degree in the subject, right? Like, they just... I just disagree with the point of view, right? So when they say everything is in the price, what I have found as someone that started as a technician and then became an economist is that you never know when it's going to stop because you don't know why it's happening. You can only measure something and tell me what just occurred and what happened in the past. And you don't know the end of it, and because you don't know why it's even happening. Okay? So if you know why, and you also know what, technical analysis is what? Yeah, no, it's not a question. It is. It's just, it answers the question, what? What is the price right now? That's what technical analysis is. What did the price do over time? Well, we can measure it with a 5 EMA, a 10 EMA, a 20 EMA, a 50 EMA, a 100 EMA, a 200 EMA. These are all statistical analysis of everything that's already happened. What happened? What happened? Oh, well, I can use algorithms, which are just things that do the math for you if you don't have a degree in statistics. Now, the reason I can knock out stuff like linear projections over price and time is because I do have an economics degree. I did study statistical analysis. I understand the math. That's why it shows that I love charts. But it doesn't tell me why things are moving. But if I understand why things are moving, I might be able to get an edge on anticipation of what is likely to happen next. But the big, because anticipation is just trying to outsmart the market. But I'm not trying to outsmart the market. I'm not. I want to go with the market. But the biggest, most powerful, most important, most impactful reason you need to know economics, macroeconomics, to understand why the market's moving, is that you know when you have congruency. Fundamentally, everything says up, and the market's just technically turned bullish. Let your winners run. And have confidence and the patience and discipline to let it happen. And you will be rewarded. If it's destined to go up 500 pips, but you're taking 20, 30, 40 pips at a time out of it, you're so unbelievably short-sighted. It's negligence. But you're like, but 50 pips is a lot for me. Well, then you need to be worth more. Your decisions are not worth very much. You take 50 pips out of a 500 pip move. What? You see, like, what? Couldn't an idiot do that? But you're like, but 50 is good compared to the other ones. Yeah, because you're buying in a falling market, of course. Of course, those trades are not worth very much, and they're very high risk. But then you're like, so I'm happy to make 50 pips on the uptrend. Wait, you're buying dips in an uptrend and you're taking 50 pips? That's it? Oh my God, right? But it's because you don't know why it's happening. You don't know how to qualify the value, right, of your trade. You don't know it's worth 500. You don't know when to get out because you don't know why it's occurring. You don't know why you just bought, but it reversed at some point, so you started buying. But then you get knocked out of the pullback. You see? So anyways, okay. Bumpy says, depends on your model. If you can consistently take 50 pips day in and day out, nothing wrong with that in terms of performance. Bumpy, that sucks. You're taking away the whole point of investing. I opened my book with a quote from Albert Einstein. The most powerful force in the universe is compound interest. And you're going to not utilize that. You're just going to take 50 pips. Well, you're not going to make any real money. So you're going to have large lot size because you only make 50 pips. What? But I understand why, because you don't know when to let them run. You don't know it's worth 500. So you'll do 100% of the work, which means you've done the analysis and you've taken the trade. So you've taken 100% of the risk, but you only ask for 10% of the reward. Dude, how could that possibly be a good model, Bumpy? You'll take 100% of the risk and 10% of the reward. Oh, well, Wayne, I'll just do it over and over and over again. Well, if you just did it over and over and over again, but let every single one of them run, one trader will make thousands of pips on that move, and you'll just take out 50 at a time. So you make 100 pips, and someone else will make 1,000 pips. One person got compounded their trades, and you didn't. It's not a better model, but that's what's preached. But it actually doesn't make any mathematical sense. So I would start with the mathematical model that makes sense and then try to emulate that in the market. Now, of course, it's difficult. Trading is difficult. Trading is risky. But wouldn't you at least agree that the math of your portfolio construction should work? So what's your portfolio construction? You'll take 3 trades a day. One loses 50 pips, one makes 50 pips, and the other one breaks even. Not a good model. You have a different model. You take 3 trades a day. One is a 50 pip loss, one is a break even, and the third one you let run to 300 pips. Then on the second day, you do it again. One loses 50 pips, one breaks even, and you let the other one run to 300 pips. So if you hit your targets, you have 600 pips, minus 2 break evens, minus 2 negative 50s. So now you've taken 100 pips in loss, 0 pips in break evens, and you have 600 pips in wins. Okay? Subtract the loss, you have 500 pips profit. You compounded. Now, maybe it takes you 2 or 3 days, so you continue the model. But someone that goes for, and on the longer run, because we're talking about averages, and most people here are probably in this situation, if you looked at 100 trades, 200 trades, 300 trades, you get more and more of a normal distribution, right? So let's do that. Let's do the statistical analysis of your portfolio strategy, and you get a normal distribution. Okay, you get here, and then you get from here, and you get here. Okay, and you have a whole bunch of trades over here that are negative 50. You get a bunch of trades over here that are plus 50. And then all these things add up to break even in the middle. Which means after hundreds and hundreds and hundreds of trades, you don't have any money. It's like playing at the casino, right? The longer you're there, the less likely you're to make money. In this case, I think once you're a good trader, and by the way, I know many of you have tried this, maybe not on purpose, but we all know this is true. That you could go 3 years of trading and you're pretty good. You're pretty good at charts. Your tools are great. You're not a bad trader at all. But after 2 or 3 years, you find out you're break even. What's wrong? your portfolio construction. And you're like, Wayne, what portfolio? I make 3 trades a day, and at the end of the day, I have no trades open. Yeah, well, there you go. You just figured it out. You don't have a portfolio. You're not constructing a portfolio. You're not a professional investor. A professional investor doesn't go home at night with no trades open. Think of it, $1 billion hedge fund. Well, they've invested their money. Okay? So what makes more sense is, can you let these ones that you've done right, can you let them run? Okay? So then you get a skew like this. Okay? And you still have a lot of break-even trades. Okay? And you still have the same losers, minus 50, because you never take bloodbath trades. When you're wrong, you're out. Now, you're like, but Wayne, it's not as easy as just let the 50s turn into 300. Okay, I grant that. So you shift this and it skews. Now, what you call this in statistics, let me get the color here. What you call this in statistics is this becomes a thin tail. And this becomes a fat tail. Oops, sorry, can't do that. Okay, and some of you might know this as kurtosis, because you're asking about the shape of the curve, because it's not a normal distribution anymore. And so you got a fat tail on the left and a thin tail on the right, because you have less that go to 300. But what happens is, because when you get to the 50, instead of taking 50, you move your stop to break even. So now let's say only 25% of your winners go to 300. It's not 50, it's not like this is 50-50 and this is, well, 30-30-30 or something, right? So what I'm just saying is you end up getting less, but we know if this is a normal distribution, you end up making 0. Okay? You move this over, but at least now, mathematically, you might have, this is equal to, this is greater than 0. Greater than 0. Oops, 0, sorry. Ooh, I can't think and talk at the same time, sorry. This is equal to greater than 0. Okay, and this is equal to 0. So how, this answers a big question that many traders have. How do you go from a break-even trader to a profitable trader? Because a lot of people tread water here. And I talk about this in that Quant Box presentation. Actually, thinking about it, do you have to be a better technical analysis to go from break-even to profitable? No. Bumpy says working on banking 200 plus pips a week is like trying to hit a home run every time. No, it's not. It's not. If you don't know what you're doing, it's impossible. If you don't know why the market's moving, Bumpy, it's impossible. My point is, I want to give you an edge, not so that you're a genius, not because you're smarter than the market. You don't have to be a better technical analysis, because we know the best still probably only break even-ish. That the only way to make money in this situation is jack up your lot size, but that will give you 0. That'll actually be worth less than 0. So the difference between a really good technician that's not getting the results they want or expect, and one that gets closer to the results they want or expect, is that they can pick and choose and know whenever you have a good trade on. And I'm not saying you only do 300. Now, in this math case, I'm trying to make a point. If you know For example, let's incorporate the two. If you know when to take 50 pips, which is in this period, and you're happy with the 50 pips, take the 50 pips. But then you also know when to go for 200 or 300, then you will end up with greater than zero. You will be profitable. And think about, well, how do you know this? Well, this comes from bias. So you're like, let's say generally speaking, you're a bull because of the monetary policy of the central bank. In periods where there's down, you're a great technician and you just know the market, yeah. Generally this year, the market's bullish. Sure. But we all know you can have 2 or 3 weeks of down. So you're smart enough to go pick up your 50 on the way down. 50. Okay? But then when the market is bullish, you know that these are worth 300. They're not worth 50. You can understand the difference. And what this ends up happening is this down period in which you're short-term short, you're actually hedging. You're making money in the counter trend, which is perfectly fine. You're hedging the long-term position because then you will have that capital that you made on the way down. You have that capital made available over here to redeploy. Now you have to understand that concept even to do it. You have to be a much higher level of thought process than the average retail trader. Because think about what you're doing. You're risking 50 to pick up 50 because you know it's going to fall. Technically, it just makes sense. But you also know it's not the long-term direction. So you're risking 50 to make 50. It costs you $50 to make $50. Okay? Your cost is $50. But now, when you know the right thing is happening for the right reason, you'll take that $50 and turn it into 300. You see? And all of a sudden it's intelligent. But to risk $50 and make $50, risk $50 and make $50, risk 50, well, you're going to need 80% profit, win ratio. And I know you can do that. I just don't think you can do it for 30 or 40 years. And the reason for it is, you will find is it's relentlessly hard work. It's like being assigned hard labor in prison. You're sitting there with a sledgehammer and a spike, a steel spike, and you're going to break rocks all day, every day. And I mean physically. Carpal tunnel in your forearms, your right shoulder is, if you're right-handed, will be destroyed. Your lower back, your upper back, your sciatic, your tailbone, your calves will be totally worn out. Your eyes will be worn out. You won't want to look at bright light ever again. You will be mentally fatigued because you're staring at 5-minute candles and you're not even breathing properly. Your stomach is turned to stone because you're hunched over, clenched in stress. I know that because I've been there. I've done all that. I'm not picking on scalpers. I'm not saying that way is the wrong way. What I'm saying is that you can enhance your returns through more knowledge and better analysis. And if somebody tells me it's all in the price, I'm like, okay, brother. Good luck. Because I know they're not going to listen to me. It doesn't matter. It's irrelevant. Doesn't Jay-Z say something like that? Does anybody know the Jay-Z quote? For those that don't feel me, they don't see me. So, does anyone know the Jay-Z quote? Jay-Z vamoose, son of a bitch. Does anyone know that one? I think I found it. Genius.com. That sounds like the right quote. He who does not feel me is not real to me, therefore he doesn't exist. So poof, vamoose, son of a bitch. So what I'm trying to say is, like, I know 70% of people listening right now will say, I totally disagree with you, Wayne. Cool. Right on. I'm not going to get in your way. I don't think I can convince you. So it's perfectly fine. You do you. I do me. We can still have drinks together, right? We can still meet up and have drinks, smoke cigars. But I know what I know, having done this for more than 20 years. I've been in that situation. I've tried that, and those are the walls that I ran into. So maybe it's me. Maybe it's a shortcoming of myself. But I understand that I went through that journey, and it drove me nuts. Right? It drove me nuts when I'd get on a trend, it'd work for 3 or 4 days, and then it would just stop. And I'm like, dude, why did it stop? Everybody, like, let's just look at this case here. Right? So, for example, down, 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 up, sell. 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 Down, Now, we know this is technicals, but even in the early days, I didn't design pivot points yet. But this idea that it was trending beautifully for 2 or 3 days in a row, and then all of a sudden there was this giant up, and then the up, and then the up, and then the up. And I'm like, well, dude, why did we consolidate for an entire month, then break out to the downside only to make a higher high? And I would go ape crazy on that. What the? And I'm like kicking chairs, and I was mad. I would do terrible things. I would adopt a puppy and then take it back. No, I didn't do that. But that would be mean, wouldn't it? But the puppy's heart would be broken. I'm like, yeah, that's how mad I was. Oh, you don't have the quote? Eighth wonder of the world. Okay. Yeah, adopt a puppy and take it back. That's how upset I was. That's so funny, isn't it? So anyway, so you have to understand, like, obviously I'm joking, but I'm not joking either. It really made me upset. Really. And here we are 20 years later, and I have a master's degree in this stuff from the greatest university in the world. Why? Because that's how much I care. I was willing to do anything, no matter how much time, how much effort, and how much money it cost. I needed the absolute best because it's my job, it's my career, it's my skill, it's my passion, it's my love, it's my sweet baby. It pays the bills, you know? It's like I wanted the best answer I could possibly get to why is the market behaving the way it is. Okay? You see? And I'm still on that journey. But now I look at this and say, oh, well, tonight there's going to be a BOJ meeting, and based on my analysis, they're going to announce no change in the yield curve control program of qualitative and quantitative easing by the Bank of Japan. So Ueda will do the press conference. The Nikkei is going to rally. And technically, we already bought the dip at the roll reversal at the bearish exit zone, long and strong going into the BOJ, and probably for the next few months. Right? Boop, boop, boop. Okay? Okay? And I'm now, I think, more about the why than the what. What is the price and time? Well, if you don't know why you would buy here, if it's just another random asset to you, I think you're only worth 50 pips. What can I say? And if I know why this is going to go up and I'm like, oh, I'm going to let this run for 3 or 4 months, I'm probably worth 500 to 1,000 pips. Same trade. Same trade. Okay. Okay. It's the same trade. Oh, my watch is now grabbing my shirt. Now, the interesting thing is there's one more just to add to this. And then Daddy's got to go to work because the market's open, right? One sort of hidden benefit of being a strategist first and then a technician. Now, bear in mind the name of my book, Strategic and Tactical Forex Trading. So, strategy first. One benefit of having a strategy before you tactically enter trades is that you're picking prices in which you already intend to buy or sell. If you can confirm it with your technical analysis, tactically, using technical analysis, right? Tactics. So what you end up doing your job now, because remember, I've done this a long time, and I first traded probably a very similar way that you're trading. I would log in every day. I would do my analysis way different than you are, because there was a different world, so don't get all upset about that. But I would do something completely different, but then I'd sit down and I'd look for I'd set up my trades of the day. What I do now is I set up the trades for tomorrow. I now set up trades for tomorrow. I don't set up trades for today. That's probably why people don't love this YouTube channel. They're like, Wayne, just tell me what to do today. Well, you should have been in the day trading group yesterday. So anyways, so what am I trying to do today? I'm trying to figure out tomorrow and the rest of the week. Which means you're thinking about tomorrow. So you're like, okay, what are the best buying prices tomorrow? What are the best selling prices tomorrow? This is going all the way back to that first floor trader example. I'm writing my order card for tomorrow. What prices would I consider selling? What prices would I consider buying? Now remember, you sell above the market and you buy below the market. And then I filter that out, maybe, through fundamentals and say, well, I really want to buy more than I want to sell. But you don't have to. You can say, well, you're a long-term bull, but if it rolls over at this price above the current market, I can sell and pick up 50 pips. But if that drops 50 pips, like I think it probably will, and then it stabilizes at my buy price, I will buy it, but I demand 300 pips. not 50 pips. I don't want 50 pips down, 50 pips up, because I know in the long run, it probably leads to break even. And once again, I think everybody here has proven that. You already know this. You found that to be true. So how do you break the mold? It's not betting more money. That's the worst thing you could do. Trying to get 80% winners? That's also a fool's errand, because what you'll do is you'll start focusing on never taking losses. And your negative 50s will turn into negative 300s. And so you're doing the opposite now of what you should be doing. So we go all the way back. How do you go from frustratingly break even to suddenly profitable? You decide when setting up tomorrow's trades, if it goes up above the market and I decide to sell, I'll sell it and pick up 50 pips. And then if it falls 50 pips, I'm going to take profit, and then I'm going to buy, and then I'm going to let it run for 300. It's no more difficult. Your charts don't change. You don't need to switch from MACD to RSI, for RSI to CCI, CCI to MACD. Oh my God. I've been using the 100-day moving average. Wayne uses the 200. That must be what's the difference. No, it's not. All of that, the difference doesn't exist on your chart. You have to know when to hold them, know when to fold them, know when to walk away, and know when to run. You see? You never count your pips. When you're sitting at the tip, oh, look, I gotta go hedge my fund. So, peace on earth, may the pips be with you, may your profits be above average. Remember, I was not talking down to you. I'm trying to lift you up. And I hope you appreciate that. I really do want you to succeed. If you're in my day trading group or in my swing trading group, we are gathering the full tribe is gathering today at 4 p.m. to plan out all of next week, brother. Next week. You're still focused on today. Oh my God. Okay. So peace on earth. May the pips be with you. May our profits be above average. That just happened.